Okay, very good morning to everyone. Welcome to the briefing then for Wednesday the 21st of September. You are not seeing things. I am wearing a tie. You'll see Will DeLucy also. We are not attending a wedding. We are attending a HSBC day. We're actually going to be running one of our simulations for a group of central bankers, which should be very interesting because they're being brought in from around the world. So if our paths do cross Mr. Kuroda, we will be having a stern word. That's the main focus for this morning. Bank of Japan obviously kicking off, this being the major trading day of the month, or months I should say, given we have the Fed as well later on today. Looking at the markets this morning, obviously the charts you can see that I'm sharing of the European US assets, you would say then that the market's taking it as a net positive at this point. The DAX, you can see, gapped up higher at the open. We then moved up technically to test R2 already before finding a bit of resistance this morning. And then looking at the S&P, likewise, if you've been following our strategy we've been issuing so far this week, Monday and Tuesday, we've pretty much repeated the same trade again, and it seemingly is also coming into play once again this morning, that being the short from the Thursday high that was seen around 44.50. That worked just on the Monday, it worked again yesterday, going off our fill criteria, and it's just coming into play again this morning. So I think that's a valid kind of strategy as well, that upside resistance around these sort of levels, given the fact that, I doubt the market's going to really have too great an appetite to really jump in and want to push the market any higher, with the uncertainty looming with the countdown just a few hours now until we hear from the Fed. Looking at the Japanese assets though, this was the Nikkei performance. The actual decision itself didn't come out till roughly 19 minutes past 5. Now, just for any of those who do stay up overnight to trade these types of events in future, again, there's no set time for when the Bank of Japan generally announces their rates. It tends to come around their lunch breaks, so more typically around 2:30 on a less important decision. They kind of just get it done. Normally, from my experience, whenever they've made any kind of more drastic policy change, it tends to get drawn out. And you can see here there's a big bout of volatility just before 5 a.m. Nothing's actually happening at that point. It's just people getting awfully nervous that they've not heard anything at that point. I've been in that situation myself. You're just waiting from 2:30. You're waiting for 2.5 hours for a statement that doesn't come. And then it comes then at 5:19 or so. Then you see that move, the initial volatility, you can see the large candlestick, and then we've powered higher into the close in terms of the Nikkei. It was a rally of around over 2% at the time. We managed to close up there around, I think it was 1.8% in the Japanese markets, hence the positive gap up we've seen in the European, like the DAX, Eurostoxx futures. Taking a look at the Japanese yen, this is more interesting. Look at that. The announcements come out, you can see the size of that initial volatility. If you were there live watching that price action, you're talking about a 1.5 point swing you're seeing in initial whipsaw price action. That's because we're going to go into some of the finer details of what the Bank of Japan done, but overall it does take a little bit of time for the market to really digest what are brand new policy or monetary policy steps. We've never seen these before, and so hence the market trades with a little bit of initial high degree of volatility and uncertainty. The worrying thing here, and we're going to talk about this more, is the limited impact. The Bank of Japan and their action they've taken has lasted the best part of 3 hours. If they were looking for a substantial, long-lasting move to counter, let's say, a stronger yen, which typically a stronger yen is more harmful to their economy given the large amount of exporters that comprise of their main stock index, and then they haven't done a very good job here. what this screams to me, I mean, Will and I were in very early this morning. Will's managed to get hold of a lot of this trade, and he's going to jump on actually in the next couple of minutes after I speak to guide you through how he traded it. But if we look back on a longer term chart here, you can see this was when this first circle I've highlighted here, this was back on the 29th of January. And if you remember rightly, that was when the Bank of Japan took the unprecedented step of taking interest rates into negative territory for the first time. That caused a huge bout of initial weakness in the Japanese yen. You can see that here on that candle. And then within the following, I would say, 2 days, we had paired that entire move. So when the Bank of Japan went negative, massive rally in dollar yen, and it paired in 2 days, and then actually the yen strengthened aggressively thereafter. Looking at today's circle, far right, the kind of depreciating returns of monetary impact, you could call it. It's not even lasted 3 hours, never mind 3 days. And this, when trying to look at a move like this, it's almost, that intuitive nature. For me and Will, we were discussing. We've seen this before. The market rallies overnight in dollar yen. They've done it. They've done something surprising. They've taken a new move to monetary easing. But it's kind of, where do you go from here? How much more can you do? Are we exhausting all the options here available? And then you start to get, when Europe comes in, a retracement. And literally, we've retraced it, the entire gain that was seen overnight in dollar yen. And it's not even 9 o'clock yet. Likewise, actually, specifically on this theme that I'm talking about right now, you can see the DAX here already starting to pull back. I think this is a combination of, you get this kind of more euphoric move in the morning. As I say, Will's going to talk you through, he traded a bit of this DAX move this morning. It's kind of almost the momentum. People chase it up higher. Psychologically, you think, where do I drive this price to? Because there isn't one new headline. It's all on a sentiment overlaying from the Bank of Japan. Everyone pushes it up to the most natural target, being R2. That's the already predefined line in the sand, if you like, technically, derived from the pivots. And then it got tested twice, and now it starts to pull back, and that as well, amplified by the fact you've got the Fed coming up. No one's going to really want to fully commit to an extended move. Then you get this kind of reversal. So, from a price moving point of view, it just sort of tends to line up with the check boxes, so to speak. So what have the Bank of Japan done? So a quick summary of what exactly has happened. So the Bank of Japan kept interest rates on hold at minus 0.1%. Now this is pretty interesting as well for the potential pullback, as we've seen with the Japanese yen. Because if you remember, domestic press agencies like Kyodo, Nikkei and so on were talking about sources that they were contemplating strongly taking negative rates further negative. The only thing is that hasn't occurred. So if anything, you could say that that's a little bit of a disappointment on that one specific area of the monetary policy that's been announced on a new package. They did, though, describe further rate cuts as a possible option for additional easing, but it's more the announcement of a new framework of two main elements that the Bank of Japan have announced overnight. The first is a pledge to cap 10-year government bond yields at 0%. In essence, this means the Bank of Japan is promising to buy any bonds offered for sale at that price. It will maintain its government bond buying, more or less in line with the current pace of 80 trillion yen a year. However, the Bank of Japan will buy fewer very long-term bonds, which should make it easier for banks to earn profits by allowing the yield curve to steepen. Secondly, the Bank of Japan has pledged to continue buying assets until inflation exceeds the price stability target of 2% and stays above the target in a stable manner. So the pledge is credible, then it should raise public expectations of the price level in the future. That in turn should lower real interest rates and stimulate the economy because loans will be paid back in a devalued currency. So two real main take-home points here. The first being that they've pledged to cap 10-year government bond yields at 0%. And secondly, they said that they pledged to continue buying assets until inflation exceeds price stability target of 2%. If you remember, that's most G7 central banks' main mandate as a price inflation level. Now, two main things when I first read this morning, which were more worrying than positive in my mind. Firstly was the fact that they've pledged to cap 10-year government bond yields at 0%, in essence saying that they will promise to buy any bonds offered for sale at that price. For me, that's kind of, you're just giving the rope to hang yourself almost. It's saying to the market, come test me, we'll just buy the bonds as soon to protect that a predefined metric. This just echoes the Swiss National Bank when they had that protection of the floor in the Euro-Swiss rates at 120. The market knew, they were explicit that they would protect the 120 floor. The market knew that. Every time it got close to, the market would just push Euro-Swiss down to 120. The Swiss National Bank would come in, they would protect it, it would bounce up a little bit, the market would run it again to 120, the Swiss National Bank would protect it again. It's almost like tempting fate. The market knows it's a safe play almost, that they're all going to step in. So do you continue to sort of force the central bank's hand? And in the case of the Swiss National Bank, you all know what happened. They were spending so much money protecting that floor that inevitably it gave way. And then you had that monumental collapse in the Euro-Swiss rate at that time. The second thing is the Bank of Japan pledged to continue buying assets until inflation exceeds the price stability target of 2%. They're looking to raise public expectations of price levels in the future. For me, this is again quite dangerous because you're relying on people's perception to be altered by what you're doing. That's then a third-party variable out of your control that needs to be changed by what you're doing. And anything that's out of, I don't know about you personally, but anything out of my own control, of me personally, putting it into someone else's hands, then the likelihood of that actually coming to fruition, I think, is lessened because you ultimately don't have full control in that situation. So whenever these types of new monetary policy moves come out, it's a key thing about just digesting, reading things. There's going to be a lot of, I guess, economist talk as we go through the morning, particularly as it could potentially be quite quiet as the market dies down after this initial volatility at the open as we gear up for the main event, which ultimately is the Fed later. Quick look at the Fed then. You know the score by now. There's a mixed bag of economic data as to whether or not the Fed will pull the trigger at this point in time. Looking here, you can see the chart I'm sharing is a strong run of new jobs. More specifically, you're looking at the last 3 months. So over the last 3 months, we've had an average headline non-farm payroll job creation of 232,000. By any means, that is a pretty strong, elevated number by what the Fed previously, in months, year gone by, have stated that 200 was the line in the sand. We're tracking comfortably above that level, despite the drop-off that we had of a 151 reading the last time out. People like, let's say, Esther George, dissenting if the Fed stays on hold. George has already dissented 3 times this year in favour of higher rates. So there's certainly one person going to be looking for higher rates today. In the opposition camp, obviously you've had Brainard, the last of those voting FOMC members to speak. And she was typically dovish, sticking to her party line. Inflation still a little bit of a concern, on the upward trend for sure, and steadying out, but still below their 2% target. Don't forget though, inflation has been below the Fed's 2% target for 4 years. So does that matter? The fact that it's stable, is that enough for them to want to pull the trigger? Moving on, as you know, with the Fed, it's going to be statement, dot plot projections, Janet Yellen. So there's 3 real key areas. So when the initial statement's made, the market's going to see the initial move on whether or not do they not hike rates. Then it's about digesting the wording from the statement and looking at this, reading the Deutsche Bank report this morning, their European economists talking about the statement of risks, that particular part of this is the last statement. Now, this is a fantastic tool we'll be using later on. It's the Fed statement tracker done by the Wall Street Journal. Essentially, you can look at June to July. So now you'll be able to look at July to September. You can match side by side. It strikes out the language changes and highlights the new additions. So it's a great way to see the subtleties and how the actual wording of the Fed has changed. And this Deutsche Bank economist is saying that the statement of risks to be upgraded to nearly balanced from have diminished. This is the bit I've highlighted here. You can see near-term risk to the economic outlook have diminished. What this guy at Deutsche is suggesting that might be upgraded to nearly balanced. That then would be a strong signal ahead of December. Now, if you remember, if they don't move interest rates today, most are believing that you might get a hawkish hold. They hold interest rates. It's probably a fairly close run affair between doing so or not doing so, but then they telegraph to the market that they certainly are serious at doing something and to intonate towards December. Then that brings in the dot plot projections, because it's the dot plot projections that you'll be able to tell then, do they foresee an interest rate hike still in 2016? Most are expecting then that will show that December is on the table. If the dot plot projections show that they've lowered it enough that there's no rate hike in 2016 on a median basis, that will be a big dovish surprise from how the market is priced. You can see here though, I showed this to you yesterday, a quick recap though. This is the last 3 dot plot projections that we've seen. The orange line, the top line, you can see that was when the Fed last hiked interest rates. That was when the Fed were telling us at the time, we're going to hike rates 4 times in 2016. Obviously, that has by far not occurred by any means. Each time, so March 16, the next line, June 16, the trajectory is getting more and more shallow, and this is a Bank of America forecast for today. They're looking at that becoming even more shallow, particularly in the near term, before interest rate hikes then might start to pick up as we get into the second half and thereafter of 2017, 2018. So certainly the dot plots will be a big area to watch. Implied market odds on the Fed acting today. Obviously this has been up and down by a huge amount really since the beginning of 2016. At the start of the year, obviously when the Fed did hike, we were up at around nearly 50% that we'd see further hikes. Now, then you had the Brexit, big collapse in those expectations to actually zero in the immediate aftermath, but then the recovery, given the fact that there was no contagion knock-on, touch wood, thus far into Europe. UK data has been much stronger than expected. Markets have bounced. External headwinds have diminished in terms of China then and Brexit fears. But then you've had this wobble in economic data, ISM data points more recently, and that's when we collapsed as well from around that 40%, Brainard in the mix as well being dovish, and we're sitting just shy of that 20% marker. Now, just to clarify our kind of view though, I think it's more aligned with, if anyone follows the former bonking of PIMCO, Bill Gross, he was talking yesterday, and I tend to err on a similar view, and that I definitely think today is more 50-50 than what the market is priced in, which is more like 15-18%. I was just listening to a pundit on Bloomberg TV a few minutes ago, and a very interesting comment I thought was that the Fed probably would have an easier time communicating to the market if it just hiked now and then starts to sound dovish immediately after. That's probably an easier way to temper expectation. Yes, you'll get a huge amount of volatility initially on the hike, but then you can just sound dovish in the dot plots, you can sound dovish in Janet Yellen, calm the market. What could be more tricky to communicate verbally and to balance market expectations is if you don't hike, because then the market, you've got to judge it in suggesting you're going to hike in the future, i.e. December, but not being too hawkish then, because then it's kind of going to be self-defeating in a way. So I think it's more of a tricky act for Yellen if they don't act today. So we shall see. Quickly to wrap things up, we did have the API crude oil figures last night, as per usual. A surprise again, following last week's unexpected draw. Following the huge storm-driven draw from the week before, traders expected a 3.25 million build this week, but API reported another surprise draw of 7.497 million, so 7.5 million draw in the headline figure. Cushing a build of 400,000, gasoline a draw of 2.5 million, distillates a build of 1.4 million. So you can see here the blue most recent bar to the downside, another pretty huge drawdown that was seen in terms of the headline figure. Not quite as big as what we had 2 weeks ago, but certainly another sizable figure. Just quickly to wrap things up, Will, if I can ask Will to just quickly jump on the mic for just a few moments to talk through a couple of the trades that he had on this morning. I think it's probably a valid thing for you guys to understand how he interpreted some of the moves from this morning. Will?
Hi, Ant, thank you very much, and hello. Yeah, a little bit choppy to be honest this morning, but there was certainly some rationale behind what I was doing. I'd say I've traded 3 contracts on the whole. First on the yen, actually both Ant and I were in the yen looking for the rebound, and that was from 730 as Kuroda started to justify. There's 730, you can see that pop higher. As Kuroda started to justify his monetary policy with a bit more hawkish commentary, saying that current policies are working, saying that Japan is on the way to recovery, and we were looking for a break here. S2, and just couldn't really take anything out of that, but certainly the long trade was there. Thank you. You'll see my chart now. So certainly the long trade was there. The other trade I had, you won't be surprised to hear, was trying to get long gold, and this is what gold has done since the Bank of Japan. Okay, this is what the move that gold has made, and gold obviously being supported quite significantly, over $10 since 6:30 this morning, as the Bank of Japan commits to even further accommodation, and especially as they mentioned the inflation, saying, as Ant was saying, it's quite crazy for a central bank saying, yes, our inflation target is 2%, but sod that, we want to smash it out the park. Come what may, it doesn't matter. We want to do what we can, and pretty aggressive. But so gold having a push higher all the way back up to 24. I would say the main trade that I've been looking at, though, was in the DAX, was in European equities, and the rationale behind that was this: in that obviously European equities gapped higher this morning. On the left here, I'm showing you the DAX. Obviously, European equities gapped higher this morning off this extraordinary monetary accommodation communication from the Bank of Japan. However, really, what's happened to the yen this morning has then been a total reversal of that move. So I was under the impression that the DAX was perhaps overbought, and I got short once and I lost a bit of money. And then I got short again, but with a better technical entry. So my second entry here was right on, and this is a really technical analysis here really playing out. My second entry was right on the R2 level here, and I managed to take a good amount out of that trade. Not quite all the way back down to the previous high, but can you see how well technically the DAX has worked here? That's a test of R2, further test of R2, recovery all the way down to the high this morning before the market opened. So technically there was a very nice play there in the DAX. But overall, net, nothing too astounding P&L wise, that's for sure. I think I'm still surprised that European equities are quite so bullish, seeing the recovery we've seen in the yen. Obviously, European banks are doing very well out of this, but this move in the yen is exactly what Kuroda perhaps did not want to see. And I think unfortunately for you guys, that might be about it in terms of opportunity until the Fed. Let's hope not. Let me just share my screen again. But one thing Ant was mentioning was I've written the technical strategy in the S&P for the last 2 days, and it's been the same, which has been short at 21.4450. That worked really well on Monday. Short at 21.4450. We just went one price below it. If you did get filled, that worked really well yesterday, and it's working really well today as well. But rather than sort of point out how well the S&P has worked technically, it just shows us the sort of wait and see mode I think US stocks are in before we get to the FOMC this evening. Okay, guys, so that's it from me. Have a good session. Look forward to seeing you in the room. Speak to you shortly. Thank you.